From Tycoon U Studios in Delray Beach, Florida, this is Options GPS with Chris Rowe and Ron Ianieri.
Welcome back to Options GPS. I'm Chris Rowe.
And I'm Ron Ianieri.
And the next thing that we're going to talk about are the diagonal spreads. Now, you have diagonal call spreads and you have diagonal put spreads. First thing we're going to cover are the diagonal call spreads. Now, diagonal call spreads are just like selling covered calls on a stock. The only difference is instead of owning the underlying stock that you're selling calls against every single month, you own an in-the-money call with a far-out expiration. So it's
stock replacement kind of call.
Yeah, stock replacement. So basically, you're replacing the stock with a call, and you're selling calls against it. Front-month calls at the money or slightly out of the money. So you're collecting premium every single month, just like the covered call strategy, only you don't own the stock. Instead, you own the call.
And that's where the leverage comes in, and that's why the returns are so much greater in your diagonal spreads than they are in the covered put or the covered call.
Right.
Because instead of owning that $80 stock, we're going to own a $20 call, but we're still going to collect the same amount of money when we sell that front month call to capture premium. So it's a great strategy, and if anybody who's going to do a covered call or a covered put should hit the brakes, reconsider, and do the call diagonal or the put diagonal instead. It's a much better strategy.
There's a lot less risk involved.
Definitely.
And speaking of risk, I hate the broken record reminder here. We care about you. We don't want you to lose everything in one trade. Keep in mind what you're doing. Ron said it. You're using leverage in this scenario. So just like when you replace a stock with a call, stock replacement, you're using increased leverage, or you can use that strategy as more of a safety strategy. So basically, you're limiting your risk by the amount of your long call. If you take the same amount of money that you would have put into a stock and put it all into that long call, you're using a lot of leverage. So you don't want to do that. Safety versus leverage, and I have to keep reminding you that, even if I'm repeating myself, because it's that important.
Well, that goes down to the two types of calculations. We showed them back when we were talking about stock replacement, about the conventional calculation where we balance the amount of contracts versus the amount of stock we would have bought in terms of shares. And we also, the risk calculation that I showed them, where we weigh and equalize the amount of money that we're willing to lose between the two. And that is the key. I mean, to make sure that you don't overspend in an option position.
Right. I mean, if you would have bought 1,000 shares of a $40 stock, it's a $40,000 trade or investment, and you don't want to put that $40,000 into the long call. So what you would do is you would buy 10 option contracts, which represents 1,000 shares of stock. If you want to use a little bit of leverage, that's okay too. Maybe buy 13 contracts, but you don't go out there and buy 30 contracts or 40 contracts.
No,
a little bit of leverage is okay.
Especially as a beginner. Especially as a beginner.
Yeah, whatever you think that you should do a little bit less than that as a beginner. But why don't you show us how the strategy works best?
You got it. Let's now take a look at one of my favorite strategies, the diagonal spread. And let's see how we set up these diagonal spreads. And you're going to see that they're very much like the covered call strategy. They're kind of the covered call strategy on steroids, though. Take a look at the construction. First, we're going to buy an out month, deep in the money option, and we're going to sell a front month at the money option or potentially slightly out of the money option in a 1-to-1 ratio. Now, we could do this with calls or puts. Doesn't matter. What's the function here? Well, first off, we've got the premium collection power of that short front month option. But this is also a directional strategy. We can use this strategy via calls to be bullish and trade an upward moving stock. We can use this strategy using puts to trade a bearish movement or downward moving stock. Doesn't matter which one we use, it depends on the opportunity we find. Both directions, in terms of the mechanism of the trade, are going to work the same way. So what you want to try to think about here is covered call strategy, replacing the stock with a deep in the money out month option. Covered put strategy, replacing the short stock with a deep in the money put. So obviously we're going to see much higher returns and a much safer strategy. Now, this strategy is fully hedged. We've got a 1-to-1 option situation. And because we are long that in-the-money option versus being long the stock, or long the in-a-money put versus being short the stock, we don't have that unlimited potential loss that we would see from the stock, making this strategy safer than the covered call or the covered put. And like the covered call and covered put, this is a longer term strategy. This is not something we're going to do for a month. This is a position we're going to put on and we're going to leave on, and we're going to roll that short call month after month after month, just like we saw in the covered put and covered call. The nice thing about this strategy, it is much, much, much more cost efficient than our covered call or covered put. We don't have to worry about using the stock. We're going to use a deep in the money out month option to replace that stock. Now, let's look at the different types of spreads we have. Because we've talked about vertical spreads, we've talked about calendar spreads. Here we see a vertical spread, the Jan 50-55 vertical. We're looking at two different options, two different strikes, but in the same month. That's why it's a vertical spread, up and down. In the green over here, what do we have? We've got a time spread. Same strike, February 55, March 55, across different months. Horizontal there, right? Time spread. If we take elements of both, take elements of our vertical spread, and take elements of our time spread, what we get is a diagonal spread. Here in the blue, you see a diagonal spread. Different strikes and different months. It has different strikes, like the vertical, and it has different months, like the time spread. So that's what we mean by diagonal. Now, obviously, we've got a premium collection component to this trade. That is that short front month option. And what do we know about premium collection? Well, we know that premium collection is all about the decay of extrinsic value. So when we look to sell our front month option at the money or slightly out of the money, we know that we're selling that front month and we're selling that at the money or close to at the money because that's where the biggest decay is. Many people that you see use out-month verticals are actually making a mistake. If you are going to trade a vertical spread and you're looking out 6 months or 8 months, you shouldn't be doing the vertical spread. We talked about the inefficiencies of selling an out-month option to collect premium. So if I had a vertical spread I was looking at 6 months out, I'd be much better leaving my long option out there because of the slow decay and moving my front month option from an moving that out month short option, which is not collecting me anything, moving it up to the front month and rolling it month after month after month. At the money has the biggest amount of extrinsic value, and it's in the front month. We talked about the covered call strategy, and we said, look, you don't buy the stock and sell a leap against it. In the same way here, you don't do a vertical in the out months. You don't get the premium collection value of that short option. Move that short option of your vertical from 6 months, 8 months out, 12 months out to the front month and sell it month after month after month for the 6, 8, 12 months, whatever. There is how we get the true value of that short option. We don't want to be selling options naked. We know that. And we don't want to be selling options at all unless we get a benefit. What is the benefit we get of selling options? Premium collection. So if we sell an option, it's simply because we're trying to collect premium. We want that extrinsic value in that option to decay. So why are we selling an out month option? Don't. Move it to the front month And when we take an out-month vertical and we move that short option to the front month, we are now making that short option productive, month in and month out. We take our out-month vertical, move that short option to the front, and what do we have? We've got a diagonal. So first off, it's a little bit of a play off that short option. Taking that short option and moving it up to the front month where it can do us some good. It's also a play on the long option. Think about it. If this is going to perform like the covered call or the covered put, how much better would it perform if we looked at stock replacement instead of the actual stock? Instead of being a covered call, instead of being a covered put, get rid of the stock component. We already know we don't want to trade stock. Get rid of the stock component and move it into a deep in the money option via stock replacement. So in a sense, this diagonal spread is better than an out-month vertical, and it's better than our normal covered call or covered put. It's in two different ways, maximizing two different strategies and bringing them together into one. Here's our decay chart. We've seen this, I don't know how many times. But the fact of the matter is, if we need to revisit it to bring it home into our head, that there is no value in selling an out-month option, then we're going to look at it another 100 times. If I do a vertical 5 months out, where's my premium collection? I sold an option. We know selling an option gives us a risk. Does it look like I'm being fairly compensated for the risk I'm taking? I don't see too much decay, and the only reason I'm going to sell an option is to collect decay. Get rid of that out-month short option and move it up front where it's supposed to be. That's why you'll only catch me, personally, doing verticals in the first couple months. Anything beyond that, I'm in the diagonal. Here's our decay slope again. Think about selling that out-month option, and think about, look at the difference between a 60-day decay slope and a 30-day decay slope. Then think about how much worse it would be if we were out 6 or 8 months. Waste of time selling that out-month option. Sell the front month, sell it over and over, take that out-month vertical you were planning on and reconstruct it into a diagonal. Take that stock, long stock position covered call, short stock position covered put, and get rid of it and replace the stock with an out-month option, and you've got a diagonal. We're taking two strategies, two of the best components of those two strategies, and putting them together the right way and creating a diagonal spread. Now, why don't we sell the front month, or excuse me, why should we sell the front month and not the out month? Take a look at this little calculator I took these figures off of. We have a stock price of 50, strike price of 50. Our days to expiration are going to be right over here. We're going to substitute them in one at a time. Our volatility at the time was 15.64% with a risk-free rate of return, interest rate 5%. If I decided to sell this 120-day option, there's $2.21 of extrinsic value. Obviously, with the stock directly at the strike, there's no intrinsic value. So the value of this option must be purely extrinsic. Okay, that's 4 months, correct? Let's pretend we sell that 120-day option for $2.21 of decayable value. Look at the difference if instead we sold the 30-day option, the front month option, 4 straight times. The first month we collect $1. Second month we collect $1. Third month we collect $1. And fourth month we collect $1. We would collect a total of $4 compared to the $2.21. Obviously, selling the front month option over and over and over again, as opposed to selling an out month option, is definitely the way to go. You can do this at home using your own trading platform. Do the same thing I've done here. Find a stock that's pretty much directly at the money. First couple days of the new expiration cycle. Take a look at the value of that front month option and how much extrinsic value is in it, the at the money. And then take a look at an out month option and don't just go 4 months, go 9 months and 12 months. Take that one. And take a look at the extrinsic value in that. And then if you go out 9 months and you took that option, times the front month extrinsic value by 9 and tell me if you're anywhere close to seeing that same number. Selling that front month option over and over again will far outperform that out month extrinsic value. This is just a simple little diagram here. You could do this at home with any stock you want to try, and you will see unbelievably different numbers. So what about profit and loss? What's our break even? Well, the break even, unfortunately, is depending on several different variables. We're using 2 different months here, and we do not have a position that has a set single volatility level between the 2 different options. We could say, hey, if all other things being equal and the stock goes here, I would break even. But you may not, because there might be a change in the volatility of the front month, which would change the value of your short front month option. Could be for you, could be against you. But there could be a change of out month volatility, changing the value of your long out month option. Could be for you, could be against you. And there does not have to be any relationship between the movements of the 2 volatilities. So when you look at a break even of a diagonal spread like the time spread, we can't really fixate on an exact break even and just say, well, all other things being equal. We can't do that because there's more than one variable affecting the price of this trade. What's our point of maximum profit? Well, in any given month, that we can decide, because we have a position that's got a short option and a long option. And we know something about maximum profit for a position that has a short option. What do we know? We know that the ideal place for the stock to finish at expiration is right on the strike of our short option. When we look at a point of maximum profit, most of the time, the maximum profit point for that month will be at expiration of our front month short option with the stock price directly on the strike of our short option. Now, can that fluctuate? Of course it can, because we've got this out month option that volatility may be affecting. They might have moved out month down. They might have moved out month up without doing anything to the front month. So because there's 2 variables working at the same time, actually 3 when you add time in, but if we go to expiration, we've eliminated the time situation, we've got 2 different options that have 2 different variables that are mingling independently of each other. So we can't focus on, hey, if the stock closes directly at the strike, I definitely make the most money I could. Maybe not, because if the stock had closed $1 lower, then the volatility increase you saw in your out month option might have exceeded this point of maximum profit being directly at the strike. You have to keep that in mind. You've got to understand that in this strategy. We have an opportunity to collect regular premiums off of a stated value of the call when we entered the trade. But that doesn't mean our maximum profit can be looked at the same way, because that call might gain or lose via stock movement or volatility, completely independent of the short option's ability to gain or lose via volatility. Have to keep that in mind. Same goes for our maximum loss. We do know we will have a maximum loss. We know that when we put the trade on, whatever we bought the call for, minus whatever we collected in that given month from our short front month option will be our maximum loss. But if we are doing this trade month to month to month, then we're constantly bringing in more and more and more premiums, which offset any potential loss of our long call more and more and more as the months and months go by. So when you say, hey, what's my maximum loss? It all depends on what time frame we're looking at. Over a longer period of time, I have the ability to absorb a lot more loss in my long call because I've collected many more months of premium in the sale of my short option. So to really focus in on our exact point of maximum profit, our exact point of maximum loss, our exact amount of dollars maximum profit, maximum loss, you have to throw a dart. So what we need to know is that this strategy is a longer-term strategy that real power comes from not only a longer-term movement of the stock in our direction, but also the behavior of volatility and time. The longer that I'm in this position, the better chance of maximum profit and the higher the potential maximum profit, the lesser chance of maximum loss, and the more likelihood that I'll have the maximum profit than the loss because of the constant collection of premiums paying down on the value of my long out month option. So our potential returns here. Well, we could try to put together and piece together how much money we've made month after month after month in the collection of the decayable extrinsic value of our front month option, and then use how much money we put out as our long option to try to figure out a percentage gain. That percentage gain is going to fluctuate month to month to month. We can't even use that as an average because we might have one time more gain in the short call and the long call holding still, but the next time we might have lesser gain in the short call because volatility's down, but the long call has gotten a stock movement that has helped it. It's really hard to see what your annualized potential gain can be. So what I normally do is start off with, this is what my long call costs, and if I sell my front month option month after month after month, at the end of the year, how much have I collected? But again, I am looking at an all things being equal scenario. We know that the stock is not just going to stay there to make Ron's calculation easier. The stock is going to move. So it's really hard to really get a good exact number of what your potential return is probably going to be, where your exact maximum loss and maximum profit are going to be, and what your overall percentage return is going to be, because you have two different variables that are acting mutually exclusively. So let's now take a look at the Greeks of the diagonal spread. Now, do remember we've got two different diagonal spreads we can do. We can do the call spread if we want to be long and are looking for an upward movement, and we've got a put spread if we want to be short, looking for a little bit of a longer term downward trend. So the delta will depend on which spread we have. If we're in the call spread, we'll have a long delta. If we're in the put spread, we'll have a short delta. Gamma in both situations will be short. The reason being is because we are going to be short the front month either at the money or slightly out of the money option. Either one of those is going to have more short gamma than the long gamma given to us by our long in the money out month option. When you think about it, the furthest spot out in terms of months and the furthest either in the money or out of the money will have the smallest gamma across the board for any of these different options. Theta. Our theta is going to be long. This is a premium collection strategy. We are collecting premium from our short front month option. Vega, again, probably will be short, but we're not sure here because Vega is a little different than Gamma and Theta. We know that Gamma and Theta are highest at the money, like Vega is, but Gamma and Theta are highest front month. As you recall, the only difference between these three strike-based Greeks is that Vega is larger in the out months. So when we're talking about an option that's out month but in the money versus an option that's at the money but front month, it could be a little dicey. It depends on the stock, depends on the situation. But odds are that you're going to be either short or long Vega, not a lot, but whichever option has the more Vega. If it's your short option, you'll be short Vega. If it's the long option that has a bigger Vega, then you'll be long Vega. How does this strategy work? Well, what you have to think about here is the covered call and the covered put. The diagonal spread is very, very similar to these two strategies in terms of its mechanism, the mechanics of it, how it works. What we're doing here is basically a covered call or covered put strategy minus the stock. We're just taking that stock component out and placing the option in. So actually, I've called the diagonal spread on some occasions a stock replacement covered call because all we're doing is taking the covered call strategy, thinking about our stock replacement strategy, and replacing the stock in stock replacement form. We're going to go and grab that deep in the money option to replace the stock. Everything else is just like the covered call or the covered put. The extrinsic value of that short option decays at a faster rate as time goes by than the extrinsic value of our long option, and we get to roll it month to month to month. The intrinsic value of our long option offsets any type of intrinsic value our short option can pick up if the stock runs up in our call spread or down in our put spread. So we have an intrinsic value offset just like we do in the covered call or covered put strategy. And this extrinsic value that we're collecting, we can look at it in different ways. It can be considered additional profit. It can be seen as a way to lower our investment cost, or it can be considered a hedge against lower stock prices. The beauty here is that we're going to have a strategy that has less risk, but a lot more pop to it. Think about this. Just say, for instance, in our covered call strategy, we buy a stock that's worth $80. And every month, we sell a $1 option against it. At the end of the year, 12 months, you've collected $12 in extrinsic value against your $80 stock. Not bad. But what if we find a $20 option to replace that $80 stock? We find a stock replacement call that's trading for $20, and we use that to replace the stock position. Now look at it. Now we sell that $1 option every month. At the end of the year, we've collected $12. But now we've collected $12 on a $20 investment because we use the cost efficiency of the options, as we talked about in stock replacement, to get rid of the stock in our covered call strategy and get us into a position that's got more bang for the buck. For those of you that like sticking with those blue chip stocks for longer periods of time, and you've considered doing the covered call strategy, dump the stocks. Get rid of the stock. Buy the stock replacement call, and then do your covered call strategy on the stock replacement call. You're going to see a much, much, much better percentage return, and you're going to have lower risk in case the stock starts trading down because you've got a lot less money up. So for those of you who like the blue chip stocks, this diagonal spread is a way to really get aggressive growth style returns from a very stable blue chip stock. Why are we using these? Cost efficiency over the covered call, covered put, for one. Instead of putting out $80 for the stock, I'm putting out $20, $25 for an option. That's a big difference. That's going to take my rate of return and jack it up big. Many people don't like investing in those big blue chip stocks because they don't do a heck of a lot. Even if you did the covered call strategy, that $80 stock bringing you $12 a year, that's not bad, don't get me wrong. But if we find a $20, $25 option to replace the $80 stock, and we're bringing in $12 a year off of that, suddenly our blue chip positions are now obtaining aggressive growth rate types of returns. They're getting the returns that some of these RIMs and more wild stocks would get, but they're a much more stable company underneath the stock that we own. And we don't own stock, we own the actual call or put stock replacement. It's safer than the covered call or covered put. We know that options, straight call, straight put, are safer than stocks. Proved it to you earlier when we were doing stock replacement. Showed you how a call is safer than the stock because a call is the stock and a put. Showed you how a put is safer than short stock because a put is your short stock plus a call for protection. That's our synthetics coming into play. So this is definitely safer than the covered call. Think about this scenario. You own an $80 stock. You're selling the front month option month after month for 12 months. I own a stock replacement call. I'm going to have a $20 call, and I'm going to sell the front month option for $1 month after month. We're both going to collect the same amount. But let's pretend something bad happens. Let's pretend that one morning we both wake up and the stock is trading at $30. Something catastrophic happened. Our $80 stock is now at $30. Well, right off the bat, if we had a full year of collecting premium, there's $12 that helps our downside. Well, if the $12 helps my downside, and I was long a $20 call, then all I lost was $8. Because my call would have lost all of its value, all $20, but I brought in $12 of premium. I would lose $8. Not a real good day for me. However, you, on the other hand, you might not get up out of bed in the morning. Why? Because you had an $80 stock. If you collected $12 over the course of the year, 80 minus 12 is 68. Your effective price in is 68. 68 down to 30, you've got what? A $38 loss. I have an $8 loss, you have a $38 loss. Who was in the safer position? Income generation. Well, we're going to be collecting premium. We're going to be generating income off of our long call position. That's what we're doing here. It's what we do in the covered call. And if we were on the put side of it, we'd be generating income from our short put. Either way, that front month option is generating a monthly income for us. And all we have to do is treat this diagonal spread like a covered call or a covered put. We also have an opportunity from profiting from stagnation. Because the stock is going sideways, it's not necessarily a bad thing for us because we are collecting that premium. Remember, you're collecting $12 on an $80 stock. Not too bad. I can see why you're not super disappointed that the stock began the year at 80 and finished the year at 80. Me? I'm feeling real good. Why? Because I just collected $12 on my $20 investment. The stock was at 80 when it started. It's still at 80. I'm fine with my return. Matter of fact, I've got a tremendous return. As I calculate in my head, bring down the one, it's over 50%, $12 on a $20 investment. And there's also the increased probability of profit. I have an opportunity to make money directionally. If I'm in the call spread, I'm going to make money on the way up. If I'm in the put spread, I'll make money on the way down. But I also have the premium collection working for me. So three things can happen. Stock goes up, stock goes sideways, stock goes down. In a normal situation, if I was just buying an option and being long it, the stock has to move in my direction or I'm going to lose. Here, the stock doesn't have to move in my direction. It could stay still. I win 2 out of the 3 ways. That gives me an increased probability of profit. Remember what we said about those vertical spreads? We said the vertical spreads gives us a high probability of profit. Why? Because it can make money in 2 ways. It can be right directionally, or it can collect premium and be right in a stagnation. The diagonal spread, as I told you earlier, has elements of both the time spread and the vertical spread. Here's one of the elements of the diagonal spread that is in the vertical spread, that increased probability of profit. The fact that I have more ways to win because I have 3 things that can happen, and now 2 of them are good, as opposed to normally only 1 being good. Now, when are we going to use the diagonal spread? Well, we're going to use the diagonal spread pretty much at the same times we would use the covered call or covered put. When we're anticipating a longer term, slow grinding, uptrend or downtrend. Obviously, in the uptrend, we're going to use the diagonal call spread. In the downtrend, we're going to use the diagonal put spread. So anytime we find that long, grinding, slow uptrend, the diagonal spread is going to be excellent. Call variety. Downtrend, diagonal spread, put variety. Once you start using these things, you're going to start seeing why I don't do covered calls and why I don't do covered puts. But I have positions taking advantage of longer term, slow grinding uptrends. I'm using diagonal spreads because the diagonal spread is like the covered call or covered put, but on steroids. So it's really good to use in jump-starting the performance of those blue chip stocks. You know, the ones that kind of go sideways forever? Try the diagonal spread on that. Don't buy the stock. Waste the time. Suckers bet. Buy the stock replacement option and then start selling your front month option for premium collection. Think of the diagonal spread, as I said before, like a stock replacement covered call. Now, when we want to go ahead and generate income from our position, that's another time when we'd like to use the diagonal spread. We like to find a stock that we feel will be stable, that's going to be like a rock, and we're going to use that as our principal. Try to make it a real safe stock, too, something that you know isn't going to lose or gain a lot, because that's fine, and then just start selling the call on it month after month between now and the day you die. It'll generate income the whole time. So what we're trying to do is, instead of using our nest egg and yanking at our nest egg, let's leave the nest egg intact and generate additional income off it. That way the nest egg stays large for a longer period of time. Now, what about chart identification? How do we locate this long-term slow grinding uptrend or this long-term slow grinding downtrend? It's important for you to see what those type of trends look like on the charts and how you can identify them quickly. And Chris is going to show you how to do exactly that. How'd you like that?
Very, very good. One of your best so far.
Well, thank you very much. I love the diagonal spread, and I know you do too. And hopefully, everybody else will see that, you know, the power of this strategy when used properly.
Yeah, I mean, this is a must-watch for you know, my Trend Rider members and anybody else, really, because I do use this a lot in the Trend Rider, and you know, I have a couple of short explanation articles on it. But I mean, that was awesome. I couldn't have done it better.
Well, I appreciate that. Now, what we need from you is we need to find the opportunities, and what we want is, I'm going to actually push you for 2 this time. You're going to do both in one shot.
Twice as much work.
Twice as much work, but I don't want you complaining. I just want you to do it. I need a long-term uptrend and a long-term downtrend, because we want to show them how we find opportunities where we're going to use that call diagonal, but we've got to also talk about the opposite equally,
right,
and that is the put diagonal, so I need the long-term downtrend also.
All right. So you want to find an opportunity when they're going to be long, an in-the-money put with a forward expiration, And then they're going to start selling puts against that to collect premium the whole time, which is going to be the downtrend.
Actually, that strategy only really came about to be popular in 2001 after we had the tech wreck, when the market just kept sliding down, but volatility started decreasing. You know, all the traders on the floor got whacked in that because, you know, for years and years and years, every time the market would trade down, volatility would explode up.
Right.
This time, the market at first did that, but then as it continued down and actually started developing into a bear market, volatility started to decrease, which caught everybody off guard. They thought as long as the market continues down, vol was going to increase and the puts were going to become more and more expensive.
Right.
And instead, they shrunk, and everybody who bought puts got killed.
Right. Well, you know, same thing with the stock market goes for the options market, where it's constantly evolving. So if maybe for 3 or 6 months you have one kind of market, 3 or 6 months you have another kind of market. As Ron said, the traders didn't know what to do because they weren't used to that kind of a market where the market was actually tanking and volatility was decreasing.
Yep.
So now that you're learning all these different strategies, you're going to know how to tackle any kind of market depending on what, you know, suits that market at the time.
That's exactly right. And if you see a market like that, you're thinking, hey, I want to play a direction. I want to play down. But I also see that it's premium collection time here because volatility is coming in. What do? Diagonal put spread.
Yeah, I mean, in 2000 to 2001, what I was doing was just, you know, I was long the puts. I was making money on the puts. But if I started to implement the diagonal put spread a lot more, and I would have been, you know, a bigger,
especially in the
bigger hero. I'm not always a hero, by the way. Sometimes I have little slumps, but I mean that was one of my times that I shined the most. So I could have done better by selling the puts against my puts.
At the end of the movement, yes, definitely. And what happened was a couple people actually started doing it in size and did very, very well. And it was the first time that, you know, traders really started thinking about the idea of the market going down and volatility going down at the same time, and the diagonal put spread is perfect for that.
Yeah, well, just remember, you know, when you can buy a put option, what happens generally is markets and stocks that are individual trade down 3 times as fast as it takes them to get up. So they're going to trade down, and then they're going to pop up right away when people start covering their shorts and pushing the stock back up. That's the ultimate time to come in and initiate your put spread or turn your long put into a put spread.
And the beauty is that because volatility has popped, you're going to get more premium out of the sale of your puts.
That's right.
So it works out really well in that type of market.
That's
so
right.
You've got to show us how to find it.
I'm going to do it, and it's going to come down to some of the same basic technical indicators. It's going to come down to the same technical approach, which is finding key price points. Again, there's a lot more to it, and there are other things that I can show you down the road, but I'm going to show you some basics and hopefully turn the lights on for you. So you ready?
You can do it, man.
I'm going to do it, man.
All right.
Bye. So for the diagonal call spread, what you generally want to find is an uptrend that's a little bit of a longer-term uptrend. Because of all you people out there that love selling covered calls on stock, finally you realize now that the diagonal call spread is going to put you in the position to make a lot more and risk a lot less. So what you have here is an uptrend. It's easy to see in hindsight. Hindsight's a beautiful thing in the stock market, let me tell you. What we start out with is, let's just say, right about here, because you're not going to see all that information. So I'm going to show you all the clues. First thing that jumps out here is the key price point right around $20 a share. Could be 19.5 or 20.5, but you could see that there is some support at these levels. Second thing that jumps out at me right away is the volume. You can see right here as the market starts to bottom out. At this point, people are questioning whether it's going to bottom out or not. But one thing you want to start looking at are the volume bars, and you can see that all the heavy volume days or heavier volume days are green, meaning that the stock moved higher when you had up volume. This is New York Stock Exchange. Now, a couple of other key price points that we just identified was right around $24. So you can see that the market bounced off again. Once it broke through this level, became resistance. Remember, old support becomes new resistance. And then you can see there's some resistance right around that level. The market didn't even allow it to get that high, but you can see it's right around the same level that it found resistance right here and support right here. Resistance. So the first thing we want to do is identify these key price points, and that's going to give us an indication of what we're going to look for later when we try to identify the uptrend and find out when it's official. Now we extend this key price point, which we found over and over and over again to be important, all the way out to the point where we're trying to decide if this is going to become a new uptrend. off of a pretty low level of $15 a share for the New York Stock Exchange Euronext. We identified the key price point that we just talked about, and then there's a lower one right here when the market bottomed out in November and then found another bottom in March. And we have to identify even the smaller key price points within the major ones, because those smaller ones can later on become the deciding factor in whether or not we want to take our position or not. You can see here we found a little bit of support again and again. Once that support was broken, you can see the market just continued lower. And it doesn't look like it's a heck of a lot, but this lost about 25% of its value from $20 to $15 a share. So that is a big deal. Let's look at the other clues that we can find. Well, we extended this. Remember we said it looked like it might have been a minor price point in these major key price points. But you can see we extended out here to where we're deciding whether or not we want to make our decision. And when we extend it out here, we want to look for a breakout. And when we do see a breakout, we want to see if that breakout is confirmed by heavy volume or if it might be a false breakout where institutions are trying to trick you, basically lure you into buying the stock. But you can not fall for that if you just see that the volume either agrees or doesn't agree with what you're saying. Now the key price point, remember, once this key price point was broken and the market traded down about 25% from that level, we have to extend this out as the new resistance level. So this is the new resistance level. Now if this part is broken, we know that something big is happening, especially if it happens on big volume. So that's what happened right here. And now we're going to look for the same exact level to become the support level. Once we break out here. We broke out, and we broke out with some pretty heavy volume. Now, typically with a breakout, you want to find a big spike in volume. Like right here, this is a major price point, and when we broke down, that was a big spike in volume. So this is a pretty obvious downtrend that was going to continue. When we break out, we want to find a big spike in volume. And you don't want to make excuses for a stock because you don't want to say, well, I want this to be a breakout so badly so I can make money. I'm going to make an excuse and say, well, there is a lot of volume on these up days. But the fact is that when you see the important breakouts here, the volume is relatively high, and every one of these red bars, just about every single one, is very low. Almost every green bar that stands out is pretty big. So this is a slow grinding uptrend, which is ideal for the diagonal call spread. Now, we're going to get down to the reason that we're here in the first place. Remember, the first thing we just did was just preliminary study of the chart. We want to identify the key price points, and we're going to remember what they are. You can see we just dimmed them here. But what we're really looking for is a trend line. So when does it become an official trend line? Once it breaks this level right here. Just so you remember from the other examples that I gave you, a trend line starts, in this case we're talking about an uptrend line. So we're starting with this low, connecting it to the higher low. It doesn't become an official trend line until this resistance level is broken. So in a trend line, it's going to bounce, and it's going to make a high. It's going to make a higher low, and has to break that high that it made in the process. That's an official trend line. That's when you know it's time to get bullish on this, and the slow grinding uptrend allows you, anytime we run into key price points like right here, that's when you're going to start to sell your front month calls. So you could take advantage of the stock being a little bit overbought. It's in an uptrend, but you want to take advantage of it being a little bit overbought. You don't want to sit through all the volatility and not take advantage of all these smaller moves. You want to take advantage. So now we see the heavy volume on the upside. We see that we're in an official uptrend. We've identified all of our key price points, and we know the right times to take advantage of this. And that's the diagonal call spread. Now you know the exact time that you want to implement it and how to take advantage and how to identify the right time to do it. So the diagonal put spread is pretty much the exact opposite of the diagonal call spread. What you want to look for is a slow grinding downtrend instead of the slow grinding uptrend. And you want to take advantage when it's just a little bit oversold by selling the front month puts and basically selling the extrinsic value. Here we have Gilead Sciences. Now let's take a quick look. Immediately we're going to try to find the key price points. We know, before even drawing this line, we can see that this is clearly in an uptrend. Now, this is a major uptrend that we see right here because while there's all these smaller uptrends and smaller downtrends that are short-term and intermediate term, this looks like potentially it could be a long-term uptrend. It's definitely more than an intermediate uptrend. It's right in the middle there. So what we do is we just simply take this low, this major low that we found when the market crashed, we extend it up to the next low, which is the higher low. And since this is clearly an official uptrend line, being that it broke this resistance level, we're going to extend it out further. Now we know that this is a key price point right here. So the market comes down to this level, and it's no coincidence that right at this level, the market closed at the trend line. The following day, it gapped down. So it looks like it closed at about $47, opened the next day at $46, ended up that day at about $45. If we extend that out, we're going to look for any kind of resistance anytime the stock gets up to the bottom part of this trend line. Knowing that we have that key price point, we're going to keep that in mind when we decide what decisions we're going to make on our diagonal put spread. One thing I just want to point out, because I want to try to point out everything that immediately jumps out at me with this chart, is we have a variation of a head and shoulders top formation. Now, you're almost never going to see an absolute perfect chart formation, textbook style. So what you see is head and shoulders top, one shoulder, here's the head, here's the next shoulder. And what happens on the next shoulder is once it breaks this neckline, which is basically a horizontal support level that you find right here, once it breaks through that, which it did before it even hit this uptrend line, that's typically the best time to get bearish on the stock. So basically, you took your bearish position right around here. You basically bought your put. That would be the ideal time to buy it at this point, or just as soon as it breaks this point. You might want to wait for the prices of options to settle down a little bit because people are panicking right here. Another ideal price point to get into this bearish position is going to be right here, and I'm going to show you why. All types of clues on this chart. We're going to take it all the way back to October. You can see that the market, after breaking, I call it the market. Whenever we're talking about individual stock, I still call it the market because there's a market for that stock. Stock trades down to about $44 a share, rallies up to this first arrow. Obviously, there's resistance here, here. Every time we try to rally up for about 3 months, we find resistance. Finally, we're able to break out of that, and we break out on relatively heavy volume. But if you look at the candlestick patterns, and again, it's not a candlestick lesson, but you can see there's indecision here, lots of small bodies. You don't have these giant candlesticks like you see here, here, or this big red one right here. Instead, you see little tiny bodies, indecision. So what we do, again, we're just doing preliminary studies right now before we decide to implement our strategy, because every now and then you see something happen in a stock, and you wonder if it would be a good time to implement a strategy. The first thing you should do is expand, zoom out, look at the chart, see what's happened for the last year. If you're looking at a strategy that has to, that possibly could last a few months, you're going to want to look at the chart for a few years and see what happened and identify these key price points that you see right here. Obviously, this was resistance, and that became the new support level just as we would have expected. As soon as we saw this drop, especially with heavy volume, we're going to look at this to be the next resistance level. So the market's down here. Remember, you can't see anything from here and to the right. As soon as the market does this, I know immediately I'm going to be looking at this same exact price point for resistance. I don't care if the stock gets down to 34 or 20. Whenever it gets back up here, this is where I'm going to look for resistance. This is going to be a good time to initiate bearish positions and possibly initiate either a long put position or even the diagonal put spread. Now we're going to draw a trend line right here. Here's one high. We connect it to a lower high. Very simple. One high, and again, it's only a tentative trend line until we actually break this support level. It's the opposite of an uptrend line. So we start with this level, market moves down, revisits the trend line, moves down again. Now it's an official trend line once it breaks that support level that you see right there. So once we know it's official, we can extend it out. So we extended it out, and the market, the stock, ran back into that same downtrend line. Now remember, the reason we do all those preliminary studies before we actually decide whether or not we want to implement our strategy is because we identify all the key price points because we want to see if they coincide with a number of other indicators and a number of other signs that we're going to see that tell us what to do. And obviously we found that this was a support level, a major resistance level became the major support level, and that coincides with that downtrend line right at the same time. So this would be an ideal situation where you want to get bearish on the stock. You could have been a little bit more aggressive and initiated the bearish position right here. Some people are more conservative, some are more aggressive. And some make the biggest mistake, and they don't identify whether they are the more conservative or more aggressive. And what they do is they end up, sometimes when they feel like they want to take a risk, they do, and other times they don't. So, they don't follow the same rules over and over again, which is very dangerous. But at this point, if you're a little bit more conservative, you have confirmation that you have a downtrend line, a horizontal resistance level, market rallies right back up to that point. Now, this big arrow is pointing to the fact that there is very little volume right here. Now, April is typically a pretty busy month. You've got tax time, you've got people selling stock for different reasons and buying stock. Some of them are selling stock to pay their tax bills. April's just, for long story short, April's a pretty big month. It's also the start of the second quarter, so a lot of funds are investing in the market. There should be a lot of volume in April, just generally speaking from a seasonality perspective. But you can see that the stock basically found a little bit of consolidation right here, basically traded between $44 and $46 a share. What happened was the stock tried to get bold. The bulls pushed it up here, bought it right through $46 a share. It was there for about a week. But when it moved up from the level of about 44, 46 to about 46, 48, especially the upper part of that, right around 48, you could see that there was not much volume. So there wasn't much conviction behind this move. In fact, this is probably up because the sellers decided to get out of the way to see if the buyers would push it up to a higher price. Because as a seller, I'm trying to sell at the highest price possible. So if I'm just nailing a stock by selling more and more stock, I'm making the price go down. And I don't want that exactly. So I'm going to nail it because I have buyers there. I want to get out of my position. Every now and then, I'm going to back off. And I'm going to be quiet. And I'm going to see if buyers come in because they're wondering if the coast is clear. The only way they find out if the coast is really clear or not is by buying stock and seeing how much is actually for sale. So there's these little games that the institutions play with each other to lure each other in or to try to drive each other into the stock. And right here you can see the stock moves up. They're basically trying to fake somebody out right here because the sellers moved out of the way. This is not up here because the buyers had so much stock to buy that they pushed through. It's kind of like a tug of war. Either the other side's going to be stronger and we're going to fall into that little muddy pond, or we're just going to let go of the rope. One way or another, they're going to pull back. What these sellers are doing is just letting go of the rope, and they're just waiting to see if the buyers come in and push the stock higher. Okay, let's move right along. I just want to point out these key price points that you see right here. You can see there's a lot of support right here, obviously, and there's a lot of resistance right here at this point. So the key price point that we're focusing on right now is $44 a share. We also know that $48 a share is a key price point. So we know that there's some support right here. So remember, we took our bearish position by buying a put. Now we can do a diagonal put spread one of two ways. I know that Ron likes to do it sometimes just by buying the put in the money out month and selling the front month. Now you can do that. Or you could take a bearish position, just a put, which is basically short stock replacement, and turn it into a diagonal put spread. And when you do that, you took your bearish position here, you're happy because you're smart and you're right, or you're a little bit more conservative, you waited till this happened and all the different important key trend lines and key price points converge. You're a little bit more confident, you're a little bit more confident that you're going to be right here. But when this starts to move lower, you might turn your long put position into a diagonal put and sell the front month. You're going to sell some extrinsic value. Because look at all these arrows. Obviously, there's a buyer out there who likes buying the stock at $44 a share. And they've got deep pockets. You can see that when the sellers try to nail it right down through this key price point that we've established from long ago, you can see, I'm going to move these arrows out of the way for a second. You can see this one candlestick down. Now what happened here was, we know that this was an up day. We know that it opened at the bottom and closed at the top because it's green. And we can see that it opened right here. At some point it made it a little bit lower with the lower shadow. That indicates the intraday activity. But it made it all the way to the top and closed right back up here with his friends. So basically, the sellers, the bears, tried to nail this stock to the point where everybody's going to panic because they know that this was a key price point. Hopefully, they're going to cause more people to sell. But it didn't work. So the buyers are pretty strong right at this level. Bought it right back up to the top. Market opened down here, closed right back up at the top. So the bulls are strong right here. Knowing that, we take our put position. Right here, we might sell front month puts and turn it into a diagonal put spread. So we said that the more aggressive bear is going to get in right here. Now, the more aggressive bear is going to get in, and he's going to be more prone to false signal. He's going to jump in too early, and he's going to find out that he's wrong more often. However, when he's right, he's going to be right earlier than everybody else is going to be right. So that's how you decide whether or not you want to be more aggressive or more conservative. Here you see that the downtrend line and the horizontal resistance converge, so that means the more conservative players are going to get bearish right at that price point. At that price point, there's a lot of things that are telling me that it's pretty much, a given, especially since there's no volume right here when they tried to run the stock up. Let's take a quick look at the candlesticks. I said in a couple of other sections that these small bodies that you see here represent indecision. So the market traded higher between here and here, and you can see that every time there's some resistance right at the top, but all these candlesticks have small bodies. So these lower wicks, these lower shadows, and these upper wicks, these upper shadows, that represents the intraday action. Although the stock traded all over here, it opened right around here and closed right around there. That represents indecision. Indecision, while there's light volume at a high level, means the stock is almost definitely, never definitely, but almost definitely going to trade lower. You can see that the conviction that you see here is in these long red candlesticks with these larger bodies. And those are down days, as you could tell, because they're red. So that's pretty much the best way to identify where you want to get bearish and also when you want to sell those puts. Remember, with a diagonal put spread, you could do one of two things. You could initiate it as a diagonal put spread right away. What you're doing is you're buying the out months and you're buying in the money. And at the same time, you're selling the front months that are at the money. Or you could have a put that you're long on because you're bearish on the stock, and you could turn that into a diagonal put spread. When you think that the stock's a little bit too oversold, you sell the front month put at the money, and you take in that premium and you short the extrinsic value.
To see how Ron selects options that match Chris's strategy, visit the members section at optionsgps.com.